How to best read cryptocurrency charts. Do you want to learn how to read crypto charts? At first sight, cryptocurrency charts may appear perplexing, but they are actually quite straightforward to grasp. The most crucial thing to watch is the price action. This is the fluctuation of cryptocurrency prices over time, which can be depicted by a line or candlestick chart. If you're interested in crypto trades and market analysis, you'll need to learn how to read crypto charts. However, technical analysis and market movements, like blockchain, have a high learning curve. In this video, we'll go through the fundamental principles you'll need to get started with technical analysis. Hey folks, welcome back to Billionaire Crypto Investor, where today's video is going to get really informative, so make sure you pay close attention. So without any further ado, let's begin. To begin with, let's consider the Dow theory, a long-standing kind of technical analysis developed by Charles Dow. So what exactly is Dow theory, and how do its principles apply to cryptocurrency? This theory is divided into 6 parts. 1. Markets have 3 types of movements. The primary movement is the long-term prognosis. How does an asset's price change over a period of a year or more? Price movements lasting 10 days to 3 months are considered medium swings. Finally, use a brief swing to see how the asset behaves hour to hour. Examining all of these trends is critical for determining how the market perceives an asset. 2. Markets have 3 major phases. The accumulation phase is when knowledgeable investors purchase an asset before the market does. Then comes the absorption phase, with rapid price adjustments as the general public begins to engage. Finally, during the distribution phase, early investors begin to sell their stakes. 3. Market discounts all news. Any fresh knowledge is swiftly absorbed by the market. The sum of the world's optimism, fear, projection, and history is considered. 4. Averages in the markets must confirm each other. Essentially, if solar energy stocks are increasing in value, you can anticipate solar panel makers to increase in value as well. Markets that rely on one another should generally move in tandem. 5. Volume confirms trends. When there are only a few actors in the space and there are price swings, it's difficult to determine the intentions of one or a few people in a market. Price changes in big volumes, on the other hand, are more indicative of the state of the asset. When a large number of people behave in the same way, a clear trend emerges. 6. Trends exist until they don't. This one is really straightforward. It basically means look at the big picture. When there are short-term market swings, always give the longer-term trend the benefit of the doubt. It's difficult to tell when one trend ends and another begins. Err on the side of the long-term trend. So those are the Dow theory's 6 main elements, and I'm sure you can immediately understand how they apply to cryptocurrency markets. We'll go over a couple more strategies today that, when paired with Dow theory, can help you get a better understanding of an asset. And by combining these ideas with additional contributing elements, we may view the crypto market from several perspectives. But before we get into the challenging stuff, you should be aware of what to look for in crypto charts and understand the fundamentals of how they work. So, let's jump right in. What to look for in crypto charts. When looking at crypto charts, there are a few things you should pay attention to and become acquainted with. First, you must determine the cryptocurrency price trend. This can be accomplished by examining the price action over time. If crypto prices are continually growing, the cryptocurrency is most likely in a bull market. However, if crypto values are declining, the cryptocurrency is most certainly in a bear market. You should also keep an eye on crypto volume. This is the amount of cryptocurrency traded over time, and it can be used to determine trends in the cryptocurrency markets. If the volume is constantly high, it indicates that there's a lot of interest in cryptocurrency. However, if the volume is minimal, it indicates that the cryptocurrency is not being traded. Finally, keep up with cryptocurrency news. This can be used to detect potential price triggers for cryptocurrencies. For example, if there is positive news regarding cryptocurrency, it is likely that the price of the cryptocurrency will climb. However, if there is negative news regarding it, it is likely that the price of the cryptocurrency will plummet. How crypto charts work. Crypto charts are usually divided into 3 sections. Number 1, the candles. Number 2, the indicators. And number 3, the order book. The candles show a currency's price activity over a certain time frame. The red and green candles reflect whether the price increased or decreased throughout that time period. The wicks represent the highest and lowest prices achieved within that specific period. The indicators are mathematical formulas that are used to identify trends in a currency's price movement. The moving average, relative strength index, and stochastic oscillator are the most widely used indicators. The order book is a record of all purchase and sell orders for a specific cryptocurrency. It illustrates how much currency is bought and sold at various prices. The order book can be used to determine support and resistance levels in a currency's price. Let's go over each of these characteristics in depth and see how important they are to consider when forming an opinion about a cryptocurrency. Market capitalization. A reasonable starting point is market capitalization. Coins with very small market capitalizations tend to behave in unpredictable ways, and vice versa. This is related to the volume confirmation trend. It's difficult to obtain a good image when only a few people participate in the market. Trends arise when there's a lot of activity. Relative Strength Index, or RSI. The Relative Strength Index compares the present price to prior performance to determine price movement. It is a ratio of the average number of days the asset was up to the average number of days it was down. Fortunately, practically any exchange and trading program will do this for you. The RSI scale runs from 0 to 100. An RSI greater than 70 indicates that an asset has been oversold and will likely fall, while an RSI later than 30 indicates the opposite. This is by no means a perfect indicator. Everyone would be wealthy if it were this simple. RSI is just another tool, like the others we've mentioned, that can help you obtain a better view of a market. Support and resistance. Support is the low end of an asset's value that is frequently struck before bouncing back up. The high end of the value that is reached before the price starts to fall back down is referred to as resistance. They basically indicate a point at which people regard purchasing an item as a good deal and a point at which people see selling an asset as advantageous. So if traders believe your coin is a steal at $100, they'll rush to buy it when it reaches that level, as it is unlikely to fall any lower. If people believe $150 for your coin is overpriced or simply a great profit, many will sell at that time and the price will not rise much higher. Of course, there are numerous additional reasons for this to occur in any particular market. However, this is only one method of analyzing cryptocurrency charts. Now we'll look at several sorts of charts as well as more complicated tools to assist you to comprehend the market. Let's start with crypto charts and movements. The Japanese candlestick chart is one of the most common forms of charts, and here's how it appears. You've probably seen them before. Each candlestick illustrates how the price has changed over a specific time period. The green stick indicates that the price has risen, while the red stick indicates that the price has fallen. The difference between the opening and closing prices for the time period is represented by the body of the candle. The shadows at the bottom show the highest and lowest points the price has reached throughout the time period. So how can we use this to better understand cryptocurrency assets? One of the most common methods is to use trend lines. Trend lines assist us in confirming and identifying various market trends. A trend line is a straight line that runs up or down and crosses at least 2 price points. A strong trend line should preferably cross as many points as possible. A trend line should, as a general rule, pass through 2 points and have at least 1/3 point to assist authenticate it. The distance between these places is also essential. When the points are so close together, it's tough to confirm a trend because there's such a limited window of time. In contrast, if the points are too far apart, it's difficult to discern how they relate to one another. Finally, consider the angle of any line you're drawing. A line that is extremely steep in either direction is unlikely to be a trend. For an asset to constantly rise or fall 30% to 40% day over day for an extended period of time is simply not sustainable. A line that's too close to the horizontal, on the other hand, is essentially a support or resistance line, as we described earlier. So what can you do with these trend lines? At their finest, they can assist you in determining how an asset's progressing and where it might go next. Their main disadvantage is that trend lines can be easily drawn on nearly any chart, so you must be able to spot incorrect trend lines as we discussed and be mindful when drawing your own, as these are only tools to assist you along the road. No system or study can predict where a market will go. These techniques can help you understand why markets behave the way they do, but they are not foolproof methods for predicting prices. Alright guys, that's it for today's video. If you enjoyed it and want to watch more videos like this, then please hit that subscribe button and ring the bell icon so you never miss any updates.